Good afternoon and a very warm welcome to all participants to this session on key amendments made to the Finance Bill 2023 and their impact on taxpayers. Just as the dust settled on the Finance Bill, many amendments have been introduced, and this has made sure that all tax professionals, whether in industry or in practice, get busy yet again studying the impact and finer nuances. So to get started today, let us first begin with a glimpse of the journey of the Finance Bill to the Finance Act. Typically, the Union budget is presented to Parliament by the Finance Minister on 1st February of every year. And after that, it is presented for approval to the Lok Sabha and the Rajya Sabha. And finally, the President's assent is received, which takes it to notification as the Finance Act. So the Finance Act 2023 has now been notified. Generally, every year, based on the feedback received from various stakeholders, some amendments are made in the Finance Bill. However, this year, there are about 64 amendments in the direct tax area alone. Some of these amendments reflect the representations made by taxpayers on the provisions of the Finance Bill, whereas some of these are completely new changes. Considering that some of these are completely new changes, we believe that a supplementary memorandum explaining the rationale triggering the amendments would have helped us better understand their purpose and purport. As far as GST is concerned, most amendments and regulations are introduced through the year, and therefore in the Finance Bill, the proposals are limited to directional changes which demonstrate a broad level roadmap of GST. A few such changes and also a couple of policy level changes relating to customs duty have been covered under these amendments. To discuss these amendments and their impact on taxpayers today, we have two extremely knowledgeable professionals here. Let me begin by introducing myself. I am Riaz Tingna, partner with Thornton Bharat and leader for National Tax Office and Professional Standards for Non-Audit Services. We have Richa Soni, who is a chartered accountant with over 25 years of experience in tax and regulatory matters, with a vast experience in direct tax, international tax, personal tax, expat tax, and transaction advisory. She leads the National Tax Office for direct tax and regulatory matters. She has been actively involved in monitoring and analyzing key policy developments and making representations to concerned authorities. She has also developed position papers on emerging tax issues, thought leadership publication on policy developments such as GAR, several other publications such as tax master guides, annual budget reports, doing business in India, etc. She will be discussing the direct tax amendments. We also have Manoj Mishra on the panel, who is an indirect tax partner with Thornton Bharat. Manoj also leads the National Tax Office for indirect taxes. He has led various assignments in his 20+ years career, including helping client transition from sales tax to VAT and thereafter from VAT to GST for companies in diverse sectors like auto, engineering, FMCG, telecom, IT, ITES, etc. He's also represented various large clients before appellate authorities like NAA, DGFT, and tribunals. Manoj has been a member of the Central GST Advisory Group for ICSI for several years and is actively involved in influencing GST policy formulation and advocacy with policymakers. Manoj also serves as faculty for ICAI and ICSI for post-qualification indirect tax courses. Now, before I hand over to Richa to take us through the direct tax amendments, just a little housekeeping note. In case any of you have questions, please put them into the Q&A box at the bottom of your screen. We'll try to address them during the course of the webinar. In case we are unable to do so, we will get back to you through email. With that out of the way, over to you, Richa, for your presentation on direct tax changes.
Thank you, Riaz. So I'll begin with the direct tax amendments. The first one, a really significant one, which is that the rates of royalty and FTS under the Income Tax Act, that is the domestic law, have been increased to 20% from the existing rate of 10%. Now, this rate of 10% has been stable for quite some time. It was there right since 2015. And this was at par with rates in various Indian tax treaties. For example, the Singapore, Netherlands, or the Ireland treaty for that matter. And it was lower than tax rates provided for royalty and FTS in certain other tax treaties, which were, say, UK, US, and Australia, to name just a few. So what was happening was that several non-residents were not opting for taxation under the tax treaty, considering it is procedurally a little bit more cumbersome as compared to being taxed under the domestic law. If you opt to tax under the domestic law and you have income only from dividend, interest, royalty, and FTS, you are not even required to file a tax return in India if the rates under the domestic law are used for TDS withholding. Now, what will happen is that pursuant to these changes, non-residents may have to opt for the tax treaty to obtain these lower rates which are available under the tax treaties. And for that, they will have to look at several procedural as well as substantive provisions. As far as the procedural provisions go, they have to furnish the form the TRC has to be furnished. Then there is the form 10F, which is required to be furnished, an OPE declaration. And they may also have to look at things such as beneficial ownership or the MLI provisions which may be relevant to a particular tax treaty. And of course, they will now be required to file tax returns if they are taking the treaty benefit, which exposes them to a greater degree of examination from the tax authorities. So in a nutshell, this change will impact the non-residents who come from a tax jurisdiction where India does not have a tax treaty, so where they are governed by the domestic rates. Non-resident where there is a treaty, but they cannot avail treaty because of any reason, say it is a transparent entity. Or non-resident where there is a treaty which provides for a rate higher than 10% and which were earlier opting for the domestic law. It is also going to impact Indian payers who were bearing tax in the grossed-up arrangements, as we call them. They may now have to look at what they can do, whether a renegotiation of these contracts is at all possible.
Richard, just one thing that comes to mind, that while these changes have come in, there will be a transitional period, and during this period, what will be the impact, that is on 31st March 23, if accruals have already been done and the payments are pending? How do you think these cases will be dealt with?
So yes, for that, Section 195, typically which governs these tax deductions, it stipulates that the tax deduction is to be happening, it should happen at the time of accrual or payment, whichever is earlier. So if in a situation, the accrual has already happened in the books before 31st March, in that situation, the 10% rate, the earlier rate, will continue to be applicable. And this is irrespective of whether the payment is done post 1st April. So this is how the transitional cases would work.
Great, thank you.
The next slide, please. As you're all aware, an attempt was made by Finance Bill 2023 to make the new tax regime more lucrative. In fact, it was made the default tax regime. There was a rebate for taxpayers having taxable income up to 7 lakh. Now, what amendment has been done is that to further promote this tax regime, a marginal relief has been provided to taxpayers where the tax on income exceeding 7 lakh is more than the income exceeding 7 lakh. That is, the amount of tax, it exceeds the amount of income over 7 lakh. So this, in a typical scenario, would kind of benefit those taxpayers who have income roundabout up to 7 lakh 28,000. So this is the additional benefit that is going to be available to this set of taxpayers. Now, as you're aware, that this had created some confusion among the employers as to how tax withholding has to be done now that there are two regimes and one is a default regime. Clarifications have been also subsequently issued after these amendments, which state that in case of salaried employees, that is employees who do not have income from business and profession. So these are cases who can do an opt-in and opt-out every year. So what the employer needs to do to comply with his obligation is to ask them that what is the regime that they are opting for. And in that case, TDS has to be done accordingly. If they do not get a response, then they have to assume that this new regime is the default regime, and accordingly, the deduction from the employer perspective has to happen accordingly. But of course, this does not mean that the taxpayer cannot change the option at the time of the return filing. So this is a clarification which has come in. We'll move to the next slide, please. Another important change which had happened by the Finance Bill 2023 was that as far as the LRS payments was concerned, the rate was hiked, TCS rate was hiked from 5 to 20%. And this was without any threshold. And this is barring the payments for education or medical purposes. Now, if what has been done through this amendment, that the term outside India has been removed. So the implication here would happen in respect of LRS payments to the IFSC. Also, if there are any forex cards, they might get covered here. It's also interesting to note that the Finance Minister, while moving the finance bill for consideration at the lower house, indicated that the representations have been made that payments to foreign travel agents or other payments under LRS, which are being done through the credit cards, is not getting captured under the LRS currently. And they've requested RBI to monitor and bring in a mechanism to, to kind of plug this loophole. So it will be interesting to see what developments happen on this account.
So, Richa, what do you think is the rationale behind, this extending this applicability to LRS remittances on the at IFSC?
So, as you mentioned, Riaz, it would have been really nice if a supplementary memorandum would have been issued to understand this in detail. But what it appears to us is that considering LRS payments are permitted under by the residents to IFSC, so perhaps it is to bring them at par with the other LRS payments. And just as this rate of 20% has been increased to widen the tax net, those people who were not filing tax returns and still having significant amount of payments under LRS, so maybe to tap that particular taxpayer base. So that appears to be the case here in the absence of any supplementary memorandum.
So I guess it could also be designed to ensure that the IFSC route is not considered taken as a loophole for people to try and move the funds through the IFSC route outside escaping the TCS limit. Yeah, I guess that is it. So thank you.
So another change that has happened is that there is a capping of TCS rate in certain cases. As you're aware, that TCS is required to be collected at a higher rate if the payer fails to furnish a PAN or the payer has not furnished a return of income for the preceding year. Now, in that case, the rate that is taken is higher it is twice the rate of the relevant section or 5%. So whichever is higher, that is the rate which is considered. Now, considering that in many cases now the rate will be 20%, a capping of 20 has been done here to avoid any hardship, because otherwise in these situations, it would have ended up being 40%. So that is another change as regards the TCS is concerned. So we'll move on to the next slide. As far as online gaming is concerned, the finance bill had proposed to introduce a separate tax regime from winning from lotteries and online games. Now, this regime was effective from 1st of April 2023. There was a separate provision relating to TDS on winning from online games, and that was effective from 1st July. So what has been done now, that there is a preponement of these TDS provisions also to 1st April, whereby both these dates are now in sync. So that is a change that has happened as far as the TDS applicability is concerned. Now, what is important here is that this TDS has to happen on net winnings. So far, what is the net winnings? The clarity has not come on that. The rules relating to that have not been released. So therefore, there might be some interpretational and practical challenges for implementing this particular provision at this point of time. Also, the fact is that here there is no threshold as against the earlier section where this provision was housed, where there was a threshold of 10,000. Here, on every rupee of net earning, there is a TDS requirement to be done, and that is to be done at the time of withdrawal or at the end of the year. So if there's a withdrawal which has happened during the year, that needs to be done. So it is desirable that this net winnings concept is clarified soon, whether it just takes into account the participation, the entry fee, or the losses of the other games played. An offset could be made for that. It would be desirable that these are notified soon.
So, no, Richard, just wanted to, sorry to interrupt again, but I just wanted to check out. Could you clarify a little bit? What do you think is going to be the impact of the change, of the preponement of this withholding tax from 1st July to 1st April?
So, Riaz, what it seems is that in the past couple of years, we've seen, say, for example, for VDS, the regime starts on one particular date, and then there is a tax withholding which starts in middle of the year. Then there are a lot of challenges working out that, how these, for this entire year, maybe the threshold amounts have to be computed, or if there's an accrual happening earlier, payment later. While the threshold perspective may not be relevant here, but this will ensure that there is a sync between the net winnings for the person and the TDS withholding. So all those challenges because of which the circulars have to be issued, that requirement may not come in. But there will be a practical challenge because it would have given some time for the industry to be prepared once the net winnings definition is out, to prepare the systems, to make them, to ensure that they are in place when these provisions get triggered. That part goes missing now when these two dates are in sync.
Great. Manoj, do you see any impact on indirect tax?
Riaz, not for this particular amendment, but even otherwise, this is a very big issue under the GST law. Because in terms of valuation, they are not able to bifurcate between game of chance versus game of skills. And as far as department is concerned, they treat everything as a game of chance and tend to levy tax on everything which is there in the wallet. Just to share with you, since it is a public domain, that biggest so-called notice under GST is on online gaming, that it is on Gamescraft, and this is for 21K crore. Thankfully, as of now, it has been stayed by the Karnataka High Court, but it is really a big issue under GST, and hopefully in the next meeting, GST Council will take it up and issue some sort of clarification to end this dispute. But as of now, yes, it is a big problem.
Thank you. Go ahead, Richard. Sorry.
So another change relating to online gaming has been that TDS is generally required to be collected at a higher rate if the payer has not filed the income tax return for the financial year immediately preceding the requisite financial year. Now, what this amendment states is that this provision will not be applicable for TDS on winning from online games, This possibly has been done taking into account the profile of the gamers that are there, the users of these platforms, and also the quantum. So maybe it would have become a little bit cumbersome if this was to actually be put in place. We'll move on to the next slide. The next amendment relates to taxation of specified funds. If you recollect, Finance Bill 2023 had introduced a special provision to tax capital gains on transfer, redemption, and maturity of market-linked debentures, and they were to be in all situations considered to be short-term capital gains. Now, what has been done here that this set of provision has been extended to unit of specified mutual funds, but thankfully there is a grandfathering. It would only apply where the units have been acquired after 1st April 2023, and specified mutual funds here have been defined to mean those funds where not more than 35% of the proceeds are invested in equity shares, and that too of domestic companies. Now, to whom it may impact? It could impact ETFs, it could impact gold funds as well. And the key change here would be now the benefit of indexation is not available, which could have earlier been availed. The capital gains, considering they would be short term, they as far as resident investors go, they would be taxed at the applicable slab rates. And also what it does is that it puts the tax on the maturity of these bonds akin to something like the income that one would get from a fixed deposit. So it kind of brings them at par to some extent with this set of change. Yet another change is the change on the rate of security transaction tax, and that's in the case of sale of options and securities. The hike here is 25% hike. If one were to gauge the impact, of course, it will garner additional revenues for the government. In terms of high frequency traders, there is possibility that due to the thin spreads on which they operate on, there is going to be an impact on their profitability. Also, there has been a recent study, a SEBI study, which indicated that 9 out of 10 individual traders in the equity F&O segment, they suffered losses in financial year 21-22. So one wonders whether this could have been done to discourage this excessive trading when in a large number of retail traders who are possibly losing money in this segment.
So you do say you feel that this could be a bit of a discouragement for excessive trade in derivative trades, and considering that while it might sound like a small increase in the rate, but considering the volume of transactions, this could have a significant impact.
Yes, and I think considering the timing of this release of the report and this change, maybe they want that the retail traders tread with a little caution. So maybe that is the intent here. Going on to business trusts. Now, as you would know, that business trusts are considered as a pass-through entity for taxation purpose in respect of interest and dividend. And for REITs, the rental income is also passed through. Now, therefore, what was happening earlier was that while this dividend, interest income, and rental income was being taxed in the hands of the unit holders, there was some income which got taxed in the hands of the trust. But there was one component which was being termed as a repayment of debt, which was not getting taxed either in the hands of the unit holders or in the hands of the business trust. So the government felt that this double non-taxation is not what they intended. So what was proposed in the finance bill that this distribution in the nature of repayment of debt, that should be taxed as income from other sources. Now, there was a lot of representation which was done around that. What is now done in these by these amendments is that these have been slightly softened. Instead of the entire debt repayment, they have come out with a term, the specified term for which a formula has been prescribed, and this is the amount which is going to be taxed. What will be considered here then is the cumulative distributions made to the unit holders. and this is to any on all unit holders. Then there are certain exceptions which are basically the amounts which have been taxed in the hands of either the unit holders or the business trust. Then from that, what is to be reduced is the issue price and any amount which is taxed in the previous year in this section. So if any offering under any other section in the past, that is a question mark. Now, there are corresponding changes in the cost of acquisition. So the cost of acquisition will be reduced by any sum received by the unit holder, except where it has already been taxed either in the hands of the unit holder or the business trust. By virtue of this amendment by Finance Bill 2023, the distributions of this nature, which are likely to be covered in 56 to 10, what to be taxable under to even when these were made to sovereign funds or pension funds. Now this has been amended, so this sort of repayments of debt or the specified sum, as now it is called, will be still exempt in the hands of the sovereign wealth funds or the pension funds. We look at this through a very simplistic example. Now here, if you were to see, we look at the distributions which are other than the ones which have been taxed as interest, dividend, or in the hands of the business trust. So these other distributions, we have to take into account the cumulative distributions. And what you will see that till the time you reach the unit price of 100, there is no taxation which is happening. But when you exceed that unit price, then there is a taxation which gets triggered in the hands of the unit holder. There are obviously corresponding changes which will keep happening in the cost of acquisition from a capital gain perspective. Now, this looks really simplistic, but I may mention that there are various complications which come up when you look at the fact that there are secondary market purchases. The unit price here refers to the initial price at which this bond has been bought. Then what if there are certain exemptions claimed under tax treaty? So there are n number of issues which arise when you do a case-by-case analysis. So therefore, that becomes important. And another aspect would be that since we are talking about cumulative distributions made to all unit holders, and there are secondary market purchases as well, some mechanism will have to be put in place by the business trust itself to ensure that all this data is available to the secondary buyers and to each unit holder at each particular step. Otherwise, it will become a little unmanageable. Moving on to the next slide, please. We'll now move on to the amendments which are proposed for the in respect of the IFSC. So the first one being offshore banking units. So here, the benefit currently that is available is 100% deduction for first 5 years and then 50% for the next 5 years. Now, what is being done is that instead of this 50% in the ensuing 5 years, it is become 100%. So the impact would be that suppose you have an OBU which is operating there for say past 7 years. For the remaining 3 years, it could now get 100% tax benefit. And the intent here seems to be to bring them at par with the other units in the IFSC, which get a 100% deduction for 10 years. Next slide, please. Moving on to the offshore derivatives. So what typically happens under an offshore contract is that the IFSC banking unit makes investment in permissible Indian securities. The income earned by the IBU is then taxed as capital gains, interest, dividend under the Act. And after payment of tax, IBU passes these to the ODI holders. Presently, income of the non-resident on transfer of these ODI entered into with IBUs is exempt under the Act, but there was no such similar exemption as regards the distributions. So resultantly, what was happening was that distributions could be taxed twice. Once when they were received by the IBU and subsequently post-distribution in the hands of the NRI ODI holders. Now, Finance Bill 2023 tried to resolve this and it made this exempt in the hands of the ODI holders if it is taxable in the hands of the IFSC unit. There were separate representations made which said that this condition, second condition of it being taxed in the hands of the IBU will create practical challenges for the non-residents. So thereby, listening to that, this condition has now been removed. We'll move on to the next slide, please. Also, the amended bill, it intends to remove the burden of surcharge and cess from income of securities, which is say dividend or interest, which is earned by a specified fund. The specified fund here is a Cat 3 AIF and an investment division of an offshore banking unit. Now, this amendment, it seems, will apply only when the specified fund is an AOP or a trust and doesn't seem to cover a body corporate. So we need to see whether this was a miss or an intentional change that has happened. Moving on to the next slide, please. Now, if you recollect, Finance Act 2021 had amended provisions of the Act to facilitate the relocation of an offshore fund in IFSC in a tax-neutral manner. And for that purpose, they had defined what an original fund would mean, what relocation means, and what a resultant fund would mean. This definition at that point of time did not cover investment vehicle, which is under the direct or indirect control of Abu Dhabi Investment Authority or the government of Abu Dhabi, or any fund notified by the government, which could possibly mean the pension funds. So this has now been changed, and an amendment has been brought to include these in the definition of original fund, which is possibility of a tax neutral relocation to IFSC. In their case, it helps in that. Moving on to the next slide. Now, coming on to dividend income. Now, dividend income under Section 115A of the Act stipulates that it is to be taxed at the rate of 20% per plus the applicable surcharge and cess, and there was no special rate which was there in the IFSC. Now, this has been changed, and dividend received by a non-resident from a unit in IFSC, it's going to be taxed at a 10% plus surcharge and cess. So what happens here is that it removes the gap or the delta between the tax treaties and the DTA rates under most tax treaties. And therefore, it will encourage the taxpayers to use the domestic law rate rather than going to the treaty rates, where there are several other requirements which have to be fulfilled, which we saw that were both on the procedural and as well as the substantive side. So this kind of gives them more stability. Moving on to two exemptions in relation to the aircraft and leasing business. One is on the capital gains side and the other is on the dividend taxation side. Now, as far as the capital gains is concerned, what it stipulates is that capital gain which arises on sale of transfer of share of an aircraft leasing company in an IFSC, which happens to an NR or another IFSC unit which is also engaged in aircraft leasing, would be exempt, but they have laid down two conditions: that this operations of this IFSC unit, which is a domestic company, would commence before 31st March 26, and the gain should arise within 10 years from the date of commencement or AY 34-35, whichever is earlier. Coming on to the dividend side. So if there is a dividend which is received by a unit of an IFSC from another unit of an IFSC and both are in aircraft leasing business, this distribution is exempt. So the net impact of both these changes is that once it, of course, incentivizes the aircraft leasing business in IFSC, it enables the setting up of multiple SPVs without tax leakage. And that is how this industry typically likes to operate, to have several SPVs. So this kind of facilitates that particular pattern of working, and any tax leakages inter se within transfers will not get triggered.
This is interesting because I don't think that there are too many units of aircraft leasing and currently based in the IFSC. So there's a clear move to try and make it more attractive to such companies and businesses. I think this is quite targeted.
Yes, and in fact, if you look at the next change that we're talking about, the tonnage tax related, what one could see probably that there are about 2 entities in ship leasing which are registered, but maybe there are more coming or there are interest being shown. So even this, it seems, is to make it more attractive and lucrative for the ship leasing entities to come and set up shop there. If we were taught to talk about these provisions, so presently, as per the Act, a company may make application to opt for the tonnage tax scheme within 3 months of date of incorporation or the date on which it becomes qualifying company. Now, a unit set up in IFSC may not be keen to opt for this scheme because there's a tax holiday of 10 years initially. But post that, under the current law, it would not have been eligible based on the wordings of this existing law. So what has been done is an enabling provision has been brought in. So if there are IFSC units in ship leasing, they could opt for this scheme within 3 months of the date on which the tax holiday period ceases under Section 80LA. Next slide, please. Then, if you, as far as the income of a non-resident is concerned, it is taxed in India if it is received in India or it accrues in India. Now, to take care of this received in India challenge being faced by non-residents, under the existing law, income earned by a non-resident from a portfolio of securities which is managed by a portfolio manager is exempt, provided it is accruing outside India, but even if it is received in a account maintained in the IPO. Now, this has been further widened and there may be activities which will be notified and which would be carried about by specified person. In that case also, even if it is received in India, then there will be no taxation triggered if it is in an account maintained in with an IPO in IFSC. Possibly, this is to attract businesses to have their accounts in the IPOs where they can run their global operations through that bank account. And here, if these received in India provisions would have been there, then a tax exposure could have arisen. So maybe this is to cater to that. Then moving on, we have last but not the least, it is interest on specified bonds. Now there is, under the existing law, TDS of 4% levied on interest from long-term bonds or rupee denominated bonds, but there is a sunset clause that these should have been issued before 1st July 2023. Now there is an amendment which states that this 9% TDS would be applicable on these bonds if they are issued after July 2023, provided there is a listing only in the IFSC. So this also seems to be attracting the listing of these bonds in the IFSC.
So, Richa, to what extent do you think that IFSC is likely to benefit from this 9% interest rate on bonds?
So, Riyaz, if we were to look at it from the overall perspective of the law, the domestic law, see the 194 LC provision has a sunset clause, and this was 1st July 2023. There was an expectation that this would be extended, but that did not happen. Considering that anything which is issued beyond that would have been taxed at 20%. Now, what they've done is that this 9% is there if you list them at the IFSC, and there is no sunset date which is provided. So it is expected that because of this, it is likely to induce Indian companies to do their listings in IFSC. Also, if you were to see this and compare it with the DTA rates of interest in various other tax treaties that India has, it appears to be very competitive. And considering that this is even less than 9% rate that certain treaties have, again, it gives more certainty because you do not have to go through all those cumbersome process of doing the tax compliances, the procedural requirements of availing the treaty benefit. So to my mind, this is likely to boost this, but we'll have to wait and watch to what extent the benefits are actually fructified. Thank you. That's it from direct tax side. I'll request Manoj to speak on the IDT part.
Manoj, you're on mute.
Thank you, Richa. And thank you. Good afternoon, everybody, and thank you for joining us. Can we have next slide, please? So, as Riyaz mentioned, due to changes throughout the year, we have very less changes in GST if we compare it with the budget which we used to see earlier. So, the first important change which we are going to discuss about is the amendment in section 23. So when they came out in the finance bill, they made this provision as they started this provision with a notwithstanding clause, which means that it will supersede provision 24, which like says about which provides for mandatory registration in case the taxpayer is otherwise not required to be registered, which means that after this provision, after had the amendment been passed, any person who is not otherwise required to register would not be required even for RCM, and it would have been big loss to the exchequers. So to take care of that situation, now they have restricted it to the cases which would be notified by the government. It means that in all other cases, even if you are not otherwise required to get registration, but liable to pay tax under reverse charge, you will have to go and get registration. So that is most important thing, which like we can say that it is a backward, like a back step. Next slide, please. Under GST section 30, the officers is empowered to cancel registration under certain circumstances. And earlier, they have been given 30 days to file for revocation of the registration. You could have filed, which was again could have been extended 30 days by the Joint Commissioner or Additional Commissioner, and another 30 days by the Commissioner. So effectively, after cancellation of registration, a taxpayer had 90 days to go and apply for revocation of the registration. Now that has been withdrawn, and government will come out with new set of rules which will prescribe that how they can go for revocation of registration. Next slide, please. Further, under section 62, an officer is empowered to do best judgment assessment in case where returns are not being filed by the taxpayers. Again, under the previous law, they had 30 days to file returns and get that assessment, best judgment assessment order withdrawn or vacated. Now it has been extended by 60 days in normal cases and another 60 days with a late fee payment of 100 rupees. So since it's 100 rupees, it is per act. So it's 100 rupees CGST, 100 rupees SGST. So effectively 200 rupees per day late filing fees would be applicable if returns are not filed within 60 days. So after 60 days, after filing, like by filing 200 rupees per day, you can go and get your assessment order vacated by filing your returns. Next slide, please. So constitution of GST tribunal was a big pain point for the assessees, as most of our appeals were pending like after finalization from the commissioner. And we know that in most of the cases, we have those adverse orders only. So it was having adverse impact on the assessee, as well as on the high courts, because where you do not have any mechanism, most of them would have approached high court, and it was flooded with writ petitions. Now we can see ray of hope, and after a lot of deliberation, they have come out with a mechanism by which they would be setting up the tribunal. They have made certain changes, which as of now look administrative in nature. However, the major change which we can see that they have introduced one more judicial member at each level. Earlier, they used terminology national bench as well as state bench. Now, national bench has been named as principal bench. They have removed the reference of regional bench as well as area benches. Hopefully, it will have some other nomenclature, but otherwise it would become very difficult for the people to approach central tribunal, because in case of disputes related to place of supply, assessee would have no option but to reach out to the principal bench only. So we hope that there would be many principal benches all across India to facilitate taxpayers.
So Manoj, here I would just like to understand if you could clarify more, what will be the implications? What are the implications of relating to all these amendments and setting up GST tribunals?
So I will start from my first slide, Riaz. So earlier, when I say that there was change in the registration, it was all about difference between section 23 and section 24. Section 24 was section 23 was independent section, and whereas 24 was superseding, but it was not superseding section 23. So there was a like jurisprudence, or there was a view that section 23 is an independent, and any person who is not otherwise required to get registered need not to get registration solely for the purpose of discharging GST liability and the reverse charge mechanism. And that hold foot when this amendment came in the finance bill, where they made this provision as superseding provision by adding notwithstanding clause. However, they would have later realized that this may have a big impact on revenue, because many assessees who are not otherwise required to pay GST. For example, printing presses, like who are into printing of books, hospitals, or many others who are dealing with non-taxable activities, would have gone out of GST net, and they would have not discharged GST liability and the reverse charge. So that would have proved to a big dent in revenue. And that's why it seems to be a considered decision that they withdraw it. And now they have limited it to some specific cases which they would notify later on. That is one. So other two seems to be beneficiary and ease of doing business, where they tend to give facility to the assessees. So by extending date when you can go for vacation of your best assessment order, or similarly in case of cancellation of registration, we hope that the new rules which government tend to introduce will be more user friendly. And even in the GST returns, we can see that they are like going with the demand made by the industry or made by the various professional bodies. It was mostly related to introduction of judicial member, which I think has been accepted. And otherwise also some nomenclature changes looks like should have been introduced or suggested by the states. So we can say that as of now, government is by far getting into ease of doing business and facilitating the taxpayers. However, that amendment in registration should looks like a backward initiative, and just to protect revenue.
Thank you. That clarifies.
And next slide, please. So this again, it is a facilitating provision. So section 13 provides the cases of determination of place of supply, where either recipient or supplier is situated outside India. So subsection 9 used to provide that place of supply in case of transportation of goods would be the place where goods are being transported, which used to create a lot of problem and denial of credit to the Indian exporters. Now, since it would be recipient-based services, it would facilitate assessee, Indian exporter, to avail credit on all such cases. Next slide, please. This amendment in the GST compensation says, apart from being administrative, one more, like I would say, policy change is there, that in this particular case, they have reintroduced the concept of tax on retail sale price. So, Raj, you would like recollect that under Central Excise Act, there used to be provisions related to charging tax on the basis of MRP or RSP on certain commodities. And we believe that after introduction of GST, such things will go away. But looks like they found that more useful, and they brought this concept for, I would say, as of now, demerit goods. And in fact, they also completed the introduction of production-based taxes on these goods. However, considering the framework of GST and the fact that GST is on supply, not on manufacturing, I believe that that idea has been dropped. But since valuation is still within their purview, so it brought the concept of charging tax on retail sale price basis. Next slide, please. This seems to be a biggest change which they brought in, and this is not just a change to levy taxes. I would say it coincides with the new foreign trade policy, where they say that it would not be incentive based but remission based export. So now, prior to this amendment, or even today, because the amendment will come into effect after it gets notified. So till now, if you are bringing in anything in your warehouse for the manufacturing purposes, like popularly it is known as mover scheme. So if you bring in goods in that particular designated area, you can bring in without payment of any duty of customs. So it includes basic custom duty, it includes additional custom duty, as well as the IGST. It is called deferment scheme. So if you are exporting, you need not to pay. If you sell it in the domestic market, then you will have to pay such duties. However, with this amended provision, though custom duty remains exempt or deferred, IGST has to be paid upfront. So for the taxpayers, or for the assessees, or for the manufacturers who are bringing in goods for the purpose of exports, it would just be a change in the working capital and some hassles related to refund, because once they export, they'll have to go for refund. But the taxpayers who are engaged in non-GST items, like say gas, their cost will go up drastically. That is one. Again, we'll have to see how things move forward from here, because if it is a policy and it replicated on other export related benefit schemes, like special economic zones, where this bill is under review of the government, if it is replicated there, then it is fine. But otherwise, it will become a big differentiator between SEZ and the mover scheme. And the intention of the government is that people should go to mover scheme, would get a big hit, and people would again start going to SEZ scheme. However, it will all depend how this bill comes out, and whether such exemption related to IGST continues under new SEZ policy or not. So that's all from my side.
So basically, this entire change in the customs, how do you see it affecting business?
So Riaz, as of today, if I am bringing in anything in under mover scheme, I need not to pay any tax. I need not to pay any custom duty. So one, that my working capital is saved. I need not to pay IGST, so my working capital is saved. And if I am exporting it, I need not to go to any department for the refund. Under the change circumstances, one that I'll have to pay IGST upfront on my inventory. And once I export, I'll have to go to, and if assuming that I am mainly into exports, I'll have to go to department and seek refund, which takes its own time, maybe like 3 months, 4 months in a normal and ideal circumstances. Otherwise, it can take more than a year as well. So till that point of time, my amount is blocked. That is one. Second, that if I am dealing with non-taxable goods, in such a case, I will not be able to avail input tax credit, and it will become my sunk cost if I'm selling it to Indian market till that for the gap period. So suppose it takes 6 months for me to actually turn around my inventory into finished product, then for 6 months it become my cost.
Thank you very much, Manoj, and for very good insight into all changes in the indirect tax. I think we have a few minutes, maybe 3-4 minutes. There are a few questions in the Q&A box. If it's okay with the panelists, I think we can take up some of those questions. Richa, most of them are connected to you, so I'll just. So, Richa, the first question we've got here is from Raghavendra Gupta, who says that is CLV benefits and tax exemptions, are they still applicable for the new tax regime option?
So here, see, basically the new tax regime, the entire thrust was that the exemptions and benefits will go away, and therefore you get a simplified scheme where the slabs and the rates are little better as compared to the other schemes. So currently, there are no benefits barring the standard deduction, which has come out recently. And of course, a little bit of impact of the surcharge if you opt for that thing, and the Agniveer scheme. Beyond that, at this point of time, there are no additional exemption or benefits that one could claim here.
Great. Thank you. Mr. Pawan Gulecha would like to know that if we opt for the old scheme and TDS is deducted in old scheme, can we change to the new scheme while filing?
So yes, if you are a person who does not have business income, this opting and opt-out can happen at the time of filing the return. So even if your employer has deducted under a particular, the new or the old regime, and you want to change it at the time of the return filing, that change can happen. And therefore it is possible that does not make you stick to that. The employer's deduction does not really stick you to a particular scheme.
So except for business income, I think there's no restriction on
business income. Of course, you can only opt in or once, and you are in the default scheme. But if you can opt into the other scheme, but that can only happen once. So as of now, all of us are in the default scheme, but one time an option can be exercised.
Great. I think we'll take one or two more questions. Mr. Sandeep Mukherjee wants to know that is there any deadline specified by when the employers have to obtain the confirmation from employees with respect to opt-in or opt-out from the beneficial tax regime?
No. So currently the circular that has come, there is no deadline, but of course you will have to do it as soon as possible before the first deduction happens. But as far as the circular goes, there is nothing which has been given in the circular, the one which gives the details about this particular deduction.
Great. Thank you. One last one, I think addressed to you, Manoj, that someone says that I have the GST registration in Delhi, but take residential property for my director in Gurgaon. No, I think this is too specific. It is a particular case. I think we can respond to it over the email. One last question we can maybe take up is whether Rule 2BB allowances are allowable under the new tax regime.
So no, even the Rule 2BB allowances are not allowable in there. So it is a very neat and clean scheme. It's no hassle for the employer and no hassle for the employee, which was leading to, these claims for deductions and exemptions led to a lot of litigation. And that was the reason to keep it simple and therefore avoid litigation and paperwork, both from a tax department and a taxpayer perspective.
Great. I think we are right on time. Thank you very much, Richa and Manoj, for a very insightful session. I thank you all to the participants for really participating in large numbers. We do have some of the questions. We'll try and address them in return, respond to them via email. Thank you very much and have a great day.